Hello there everyone, hope you're doing well in this rain, sleet and snow. It's bloody awful out there, but anyway, it's always warm in the tax world. So let's talk about a new approach from HMRC, so-called nudge letters. Now, over the past few years, HMRC have had various issues with various aspects of in the tax world and taxpayers particularly, where they don't think that people are doing what they're supposed to. In other words, under-declaring income in all sorts of areas. They've had things with landlords, where they've targeted landlords, where they said, look, we know you've sold something, the land registry's told us, why haven't you declared the gain? Targeted various different sectors, all sorts of different things. The latest one that they're getting worked up on is dividends, under-declared dividends. So if you are a business owner, you're self-employed, however you run your business through your own SME limited company, technically you're not self-employed, you're an employee of your own company, but you get my gist, and you pay yourself often in a tax efficient manner, minimum salary enough to get your credit for state pension and the top up via dividends. Now, what HMRC is concerned is that people are under-declaring the dividends and they're not putting on their personal tax returns how much dividends have gone through their accounts. And it got me thinking, well, why? Why would anyone, well, but why? I mean, it's as long as time itself. People will try it on, yes, but why specifically is it hard for HMRC to not have full visibility on this? And then it got me thinking about the changes to company law that happened about sort of 10 years ago. And I want to just explain what I mean by this. So let's just have a look at a random set of accounts. So extracts from full statutory accounts for a limited company making widgets, small company, husband and wife shareholders say, and this is what the accounts look like that got filed with HMRC about a decade ago. So run with this. Made up these numbers, totally made them up. Profit before tax for the year, 150,000. So let's say the corporation tax was 20 grand. So yes, some of you might go, hang on, that seems a bit low at 150, but assume they bought some stuff on the balance sheet, claimed capital allowances, electric car, I don't know what. Anyway, just go with this figure, 20 grand corporation tax. So profit before tax 150, corporation tax 20, profit after tax 130,000. Now, on a balance sheet of a set of limited company accounts, at the bottom, under shareholders' funds, you have what's known as the retained earnings figure. And the retained earnings figure is basically everything you've ever made since day one that you've been in business in that limited company, everything that you've ever made profit-wise that you haven't stripped out in the form of dividends, basically. So the profits that you've left in your business and accumulated over the years. Now that's always there on the account. So assume 370 grand. These guys have been in business a while. They've built up 375 grand of accumulated profits that they haven't drawn out. Very good. So then what normally happens, well, what used to have full visibility to HMRC was that you'd say, well, retained earnings brought forward of 370. The profit for this year after the corporation tax is 130,000, as we've already mentioned. So you say, well, we've got my profits brought forward that I haven't stripped out. We've got my profits for the year after tax added on of 130,000. Then we're going to knock off dividends. So we're going to pay ourselves £100,000 dividends, 100 grand, leaves us with retained earnings carry forward of 400. So 370 cumulative, 130 in the year, that takes you to 500. Knock off 100 grand dividends, you're at 400 grand. And HMRC had full visibility on this because when you file company tax returns, the accounts get tagged on with the company return. There you go, 100 grand. So it was really easy for HMRC to say, okay, let's just cross-reference that figure to the tax returns. Like I said, Mr. X, Mrs. X, maybe they did it 50 grand each. So that's pretty straightforward from HMRC to say, look, 100 grand, there's 50 on one of them, 50 on another, job's a good one. Now, what has made life harder for HMRC and why they're getting so worked up about it now got me thinking, so what's changed? Well, what changed was this is no longer the legal requirement for presenting accounts. It used to be. And what happened about a decade or so ago was that the requirement to show this bit here, the reconciliation between brought forward reserves, carry forward reserves, disappeared. So now, when you're filing accounts, when you're submitting accounts to HMRC with your corporation tax, this is what you have to show them. Yes, you're going to see the profit. Yes, the taxman's going to see the corporation tax. Yes, they're going to know what the profit after tax is. But it's this bit here. On the balance sheet, retained earnings brought forward 370. Retained earnings carry forward 400. So in other words, that figure there and that figure there are still being showed, but there is no requirement anymore to separately show what dividends are, like they used to be. So you can kind of work it out. So the taxman says, well, look, we can kind of work it out anyway, and we still think that there's people are under declaring on their personal tax returns dividends. Why are they under declaring it? Is it because they think that HMRC can't work this out? Because all you've got to do it's like fill in the blanks. So you'd say, well, that to that, the difference is 30,000. Well, we know that the profit after tax is 130,000, so the difference has to be 100 grand of dividends. But it's not visible. You don't have to show that on your company accounts anymore like you used to 10 years ago. So hence, it got me thinking as to the reason why HMRC thinks there's a problem here, and I reckon it's due to the fact they changed the company law to say there ain't no requirement to be showing this dividend line separately. It's kind of buried in here somewhere, and you have to go and say, well, it's plus that, less that, minus that, boom, comes back to a figure. And that's the reason why I suspect HMRC are thinking that people, taxpayers, are not declaring the right amount because there ain't no visibility on those dividends in the accounts. And maybe, I can't think for the life of me actually, that just because there's no visibility in the accounts that the taxpayers don't know the underlying figures and they're getting that wrong. Maybe people are trying it on because they think, well, HMRC can't see this, but HMRC is saying, well, look, actually, even though we can't see it, it's pretty easy to work out, as I've just shown. So that's the latest thing that HMRC has got to be in their bonnet about: undeclared or underdeclared dividends on tax returns, i.e. whatever that figure should be, because even though they don't have visibility, they can still work it out, and then cross-referencing it to the respective shareholders' tax returns doesn't agree. So, hopefully you're not in this situation where you have been under-declaring your dividends. If you are, maybe you will get one of these so-called nudge letters from HMRC, where a nudge letter is like they're saying, look, we know you might have done something a bit wrong. Do yourself a favour, put it right now, settle what you owe, and we're not going to throw the book at you, basically. Rather than wait for a formal inquiry where they could come down to you like a ton of bricks. So there will be thousands of these letters, apparently started on the 5th of February, to all sorts of limited companies where HMRC believe that this figure that they can deduce, because, like I said, they no longer have full visibility. Mind you, there's nothing to stop people from filing that bit, even though it's not a legal requirement, and then just give the taxman all the information they want to know to begin with. But like I said, it's not mandatory like it used to. So look out for that. If you do get a letter through the post about dividends, and it could be that you haven't done anything wrong. It's maybe because HMRC is trying to work this out. And of course, bear in mind that there's all sorts of different year ends for limited companies, not just 31st of March. So often there'll be some, let's say in these set of accounts, there'll be two different tax years. What if this was a December year end or a September company year end? You'll have some dividends falling in one tax year, some in another. So it could be, if you do get one of these things, you're all right, because you just need to explain where the dividends have gone, in which tax years, on whose returns, because taxman had no full visibility and they want to know. But like I said, something might have slipped through the cracks, and for whatever reason, you may have to make good any shortfall. But for goodness sake, do not ignore any such letters if they do land on your doorstep from HMRC. So just an overview there on the latest nudge letters, HMRC targeting underdeclared dividends from owner-managed businesses not ending up fully on the respective shareholders' tax returns. If you like this video, please do subscribe. And as always, I'll see you soon.